This conference will now be recorded.
Right. This is a 2016 LL paper question, capital budgeting. 2016 question number 5A. Right. Shall we all read the question? Manufacturing company is considering to replace the existing machine with a new machine to improve the efficiency of its operations. They are currently having a machine. They are going to replace it with a new machine, which means you are going to sell the existing machines and you are going to get a new machine. Useful lifetime of this machine is 5 years. Both the machines could be 5 years, and the estimated cash flows are given for the two machines, right? New machines and the existing machines, both they have given. Right. Now you can see, if you are buying, now if you go through the this is 2016 question number 5A. If you go through the new machine cash flow information, if you go through the new machine cash flow informations, there is a cost of 1 million, and there's a residual value of 200,000, and the operating cost they have given. But if you get the existing machine, there also you have the operating expenses. Now you can see, when you use the existing machine in the first year, you're about to incur 300,000. If you use the existing machine as operating expenses, you're about to generate 300,000. But if you replace it with a new machine, you wanted to incur only 100,000. Therefore, if you buy the new machine, there is a saving of 200,000. There is a saving of 200,000. That 200,000 is the, got it? That 200,000 is the benefit or the cash inflow of the new machine in the first year, right? And also it says, if the new machine is purchased, additional working capital of 280,000 will be required at the beginning of the project. That will be recovered at the end of the project. And the required rate of return is 10%, which is the rate of discounts. The discounting factors at 10% they have given. They are asking you to have the schedule comprising the cash inflows and the cash outflows and the net present value, right? Okay, shall we identify the cash inflows and the cash outflows? Right. For that, we are using this particular answer format. Right. Could you tell me, in year 0, what are the cash flows that will be generated? What are the cash flows that will be generated? This is 2016 question number 5. Right. If you buy the new machine, definitely you will have to pay 1 million in cash. Am I right? If you are buying the new machine, you are supposed to pay 1 million in cash. So then that 1 million generate the cash inflow and outflow. Cost of, exactly, it generate the cash outflow of how much, Pata? Rupees 1 million. Yes, that is rupees 1 million. Clear now? Yes. And it further says, if you are buying the new machine, Puta, you could sell the existing machines and generate 300,000 on the same day. Therefore, current market value of the existing machine will generate how much? 300,000. Keep in mind, you can sell the existing machine if you purchase the new machines only. Therefore, that is a relevant cash flow of the new machine. If you buy the new machine, you could generate the existing machine for 300,000, which is a cash inflow. Market price, which is opportunity cost adjustment. Market price of existing machine, rupees 300,000. Clear? Right. The residual value of the new machine is how much? 200,000. But the residual value of the new machine you consider as a what? Cash inflow at the end of the project. End of the useful lifetime of this project. So then how long the useful lifetime of these? 5 years. Then this residual value 200,000. 200,000 you consider as a cash inflow at the end of the project. Is that clear now? Yes. Then what is the benefit of buying this machine, Kuta? What is the benefit of buying the new machine? You could reduce your operating cost. If you continue with the existing machine, in the first year you are supposed to incur operating expenses of 300,000, but if you replace it with the new machine, you are supposed to incur only 100,000. Therefore, if you buy the new machine, there is a saving of rupees 200,000. There is a rupees 200,000, which is a cash inflow. So then you consider as a saving. So then that is the benefit of this machine. Saving. Right, this particular question doesn't consider, the examiner has not given the effect of the increase in income. We'll assume we'll get the same benefits, right, from the machine A, from the existing machines and the old machine, the existing machine and the new machine. You are supposed to generate the same income. That is assumption. If the same income is there, there's no any incremental amount. Therefore, you don't want to think about that part. Only benefits you get from this machine is there is a saving of cost, right? Then cost saving in the first year, rupees how much? 200,000, which is a benefit. In the second year, also 200,000. Third year, 320 minus 120, that also 200,000. Fourth year, also the same, right? 320 minus 120, 200,000. Fourth year, it's 120,000. Fourth year, it is 120,000. Right. No, it's 220,000. Fourth year, it's 220,000 expected cash savings. Is it the only cash flow, Buddha? No, there's a working capital investments in this project. How much the working capital investments? Working capital investment must be done in year 0, which is 280. There's a cash outflow. And whether the question mentioned or not, you need to consider the working capital investment will be recovered at the end of the project. At the end of the project means at the end of the 5th year, you're about to recover this, which is 280,000. The same amount is recovered, but the time values are different. Present value are different. Right. Okay. That's all. Did I record all the transactions, all the cash flows? Yes. Now to take the total, what you're supposed to do? To calculate the net present value, you'll have to get the total, right? Then you get the net cash flows, right? What are the net cash flows, Buddha? Take the total of each cash flow that you have recorded. Now, as you can use the calculators in the A-level examination for the accounting paper, it is very much easier to now do the calculations using the calculators. Right. Working capital recoveries. What are the cash flows in the 5th year? Residual value of the investments, the cash savings in each year, working capital investments, right? Everything they have recorded. Now tell me, these cash flows we recorded are in the present value or the future values? Those are in the future values, but I need to calculate the present value of these to calculate the net present value. Tell me, Buddha, how do you convert the future value into the present value? How do we convert the future values into the present value? You multiply the future values by the discounting factor. Future values, when you multiply by the discounting factor, what you get? The present value, right? We'll get the discounting factor. In year 0, discounting factor is 1 at any rate of discounts. Year 1, discounting factor is 0.91. Year 2, 0.82. Year 3, 0.75. Year 4, 0.68. Year 5 is 0.62. Yes, it's 0.62. Right. Then these net cash flows, which are in the future values, you multiply by the discounting factor, then you'll get the present value. Now everything in the present term, right? Okay. Now do the calculation. Future values you multiply by the discounting factor. It's 980, and you can apply the same formula for the
So, year 2 discounting factor is 0.83, right? Not 0.82.
83. All right. Okay. Now is that clear? Is that correct? Yeah. Okay. Now I have done the calculation properly. Is it? Yes. Then calculate the NPV. Tell me what's the formula in calculating the NPV, Puta? Formula is present value of the cash inflows minus present value of the cash outflows. Right. How much the present value of the cash inflows, Puta? Take the total of all the present value of the cash inflows, which is 1,068,000. Present value of the cash inflows 1,068,000. This minus present value of the cash outflows, which is 980,000. Clear now? Then the net present value is it 88,000? Net present value of the project is 88,000. What are the cash flows you consider? Initial, the cost of the new machines, market value of the existing machine, residual value, cash savings, working capital investments, and the recovery in the investments. You need get the net cash flows in the present value, future values, and then you multiply them by the discounting factors, and then you got the present value. Present value of the cash inflows minus present value of the cash outflows is equal to the net present value. Right. Last requirement what they're asking, recommendation to select the project based on the NPV. Would you select the project, Kuta? Would you accept the project? Yes or no? Yes.
Yes.
Project should be accepted as there is what? Positive NPV. As there is a positive NPV. Right. You all can write then. Above project should be accepted. Above project should be accepted as there is a positive NPV. As there is a positive NPV. Right. Okay, Pita. That is 2016 A level question number the capital budgeting question. Right. I hope you all have understood all the calculations here.